welcome to the deep dive. Today we're really getting into a big piece of proposed legislation, H.R. 11. It just came out of the Committee on the Budget. This is May 2025.
That's right. And this bill, well, it could mean some pretty significant changes.
Exactly. So we want to break down what it might mean for different groups across the U.S. economy, the wealthy, the middle class, and folks facing poverty.
And our mission here is pretty clear. Stick to the text. We're looking directly at what's written in H.R. 11 to see the potential upsides and downsides for each group.
Right. No speculation, just what the bill says. These huge bills can be really hard to unpack, so we're aiming to pull out the parts that could really matter to you.
Let's do it.
Okay, so let's kick things off with the wealthiest Americans. Looking at H.R. 11, it seems like there are definitely some areas that could be, well, financially advantageous for them. Tax relief seems like a big one.
Yes, absolutely. The bill talks about extending certain provisions from the Tax Cuts and Jobs Act. That's in Subtitle B, Part 1.
Okay, so keeping some existing tax rules going.
Pretty much. For instance, Section 11-1001 extends something called a special depreciation allowance. It's for certain kinds of property.
A depreciation allowance.
Yeah.
That lets businesses write off asset costs faster.
Exactly. But it's not permanent. The bill actually starts phasing it out in 2028. For new property put into service after 2027, it goes down to 0.
Ah, okay.
However, there's a bit of a carve-out. If someone acquired property before 2025 and they put it into service before 2028, they can still get a 20% allowance.
So for people or companies who made those big property investments fairly recently, there might be some continued tax benefits for a little while longer.
That's the idea. It cushions the phase-out for some existing investments.
Got it. What else in the bill looks like a potential plus for wealthier individuals or their businesses?
Well, Section 11-111-101 brings in another special depreciation allowance. This one's for what the bill calls qualified production property.
Production property, so like factories, manufacturing equipment?
That seems to be the target, yes. It applies if construction starts after January 19, 2025, but before the start of 2029, and the property is actually up and running before January 1st, 2033.
So an incentive to build new production capacity.
Seems like it. We also see Section 111-102 renewing and enhancing opportunity zones.
Opportunity zones, I remember those. They were supposed to encourage investment in lower income areas, right? How does enhancing them help the wealthy specifically?
Well, the core mechanism is still the tax break on capital gains. If you reinvest profits into these designated zones, you can potentially defer, reduce, or even wipe out the taxes on those gains.
Okay.
The enhancement here seems to zero in on investments in qualified opportunity zone businesses that are located in rural areas. This could make those specific investments extra appealing for wealthier investors looking for those tax advantages.
So potentially steering investment towards rural OZ businesses?
Yeah.
What else?
Then there's Section 111-103. This increases the dollar limits for expensing certain depreciable business assets right away. That's the Section 179 deduction. Basically, businesses can deduct more of the costs of certain assets up front instead of over time.
More immediate write-offs.
Yes, and it also adds an inflation adjustment starting in 2025, so those higher limits could keep rising. It's really about making business investment more attractive from a tax perspective right now.
Makes sense. More immediate tax benefits. Are there other business-specific provisions?
Section 111(10) raises the gross receipts threshold for what counts as a small manufacturing business for certain tax accounting rules. It bumps the limit in Section 448(c)(1) up to $80 million for manufacturers.
$80 million? That doesn't sound very small for everyone.
Well, no, it could certainly cover some pretty substantial operations that might be owned by wealthier individuals or larger firms, giving them access to simpler accounting methods.
I see. Anything else on the business side?
Lastly, Section 11-11175 extends the base erosion minimum tax amount, often called BEAT.
Ah, the BEAT tax. That's aimed at large multinationals, right? To make sure they pay some minimum U.S. tax.
Exactly. Extending it provides some certainty for those large companies about the rules they'll be operating under.
Okay, so summing up for the wealthy. Potential wins from extending some tax rules, these new depreciation options, boosted opportunity zones, especially in rural areas, higher immediate expensing for assets, maybe simpler accounting for larger small manufacturers, and some certainty around the BEAT tax. Now, let's flip the coin. What are the potential downsides in H.R. 11 for wealthier Americans?
Right, it's not all benefits. Section 11011, for example, puts a new limit on the tax benefit you can get from itemized deductions.
Itemized deductions. like state and local taxes, mortgage interest, charitable giving.
Those kinds of things, yes. This provision basically says your total benefit from these deductions gets reduced. It's calculated as 2/37ths of either your total itemized deductions or your taxable income, whichever amount is lower.
Huh. So even if you have significant deductions, the actual tax saving you get from them could be less than before.
That's the potential impact, yes. It claws back some of the benefit, particularly for higher earners who tend to itemize more.
Interesting. What else could pose a challenge?
Section 11-1004 mentions potential changes related to GILTI, that's Global Intangible Low Taxed Income.
Right, complex international tax stuff.
Very complex. It basically taxes certain overseas profits of U.S. companies. Any changes here could potentially mean higher tax bills for some multinational corporations, and indirectly, their shareholders, who are often wealthier individuals. The specifics would need, a deep dive by tax experts.
Okay, so GILTI changes are something to watch. What else?
Well, that extension of the BEAT tax we mentioned, Section 11-1005, while it provides certainty, it is still a minimum tax. So for some large corporations it targets, its continuation could mean a higher tax burden than they might otherwise have.
Right, certainty isn't always a financial benefit if it locks in a tax.
Yeah.
Good point. And what about carried interest? That often comes up in discussions about taxes for the wealthy, especially in finance.
It's in here. Section 11-1006 addresses carried interest. It extends the required holding period under Section 161.
Carried interest being the share of profits investment managers get.
Right. And currently, there's a specific time you have to hold the underlying assets to get the lower capital gains tax rates on that income. This bill proposes making that holding period longer.
Which would make it harder to qualify for those lower rates.
Potentially, yes. It could reduce the tax advantages for those investment managers receiving carried interest.
Okay, so for the wealthy, it really does look like a mixed bag. Some potentially valuable tax breaks and business incentives, yes, but also these new limits on deductions, possible hits from international tax changes like GILTI, and less favorable treatment for carried interest. Makes sense.
Seems like a fair summary.
All right, let's shift gears then. Let's talk about middle-class Americans. What potential benefits does H.R. 11 seem to offer them?
Well, Part 2 of Subtitle A is actually titled Additional Tax Relief for American Families and Workers, so clearly aimed here. And there are some pretty direct items. Section 110101 says no federal income tax on tips.
No tax on tips.
Wow. And Section 110102 says the same thing for overtime pay.
That could be huge for people in service jobs or anyone working extra hours. That's direct money in their pockets.
It really could be. A direct boost to take-home pay for potentially millions of workers.
What other tax relief is aimed at this group?
Section 110103 introduces an enhanced tax deduction specifically for seniors. It references a new Section 224. This deduction would be adjusted for inflation each year, which is good. You'd need your Social Security number.
Okay, an extra deduction for seniors.
Yes, but it's important to note, this one has a sunset date. It's set to terminate after 2028.
Ah, so a temporary boost.
Seems that way. Then, Section 111004 proposes making interest paid on car loans non-taxable at the federal level.
No tax on car loan interest.
Correct. It references a new section, 163H, 4A. It also includes rules requiring lenders to report to the IRS if you pay $600 or more in interest during the year.
That could definitely help household budgets, with car payments being such a big expense for many families.
It could certainly add up, yeah.
Any provisions focused on helping families, maybe with kids?
Absolutely. Section 110105 enhances the tax credit for employers who provide childcare benefits. It amends Section 45F.
So encouraging companies to offer, like, on-site daycare or help paying for childcare.
Exactly. It could make it more financially viable for employers to offer that kind of support, potentially making childcare more affordable or accessible for working parents.
That would be welcome news for many.
And Section 110106 extends and improves the tax credit for paid family and medical leave. That amends Section 45S. It gets into specifics like minimum leave duration and wage replacement percentages. Again, the goal is encouraging more employers to offer paid leave.
More access to paid leave would be a huge benefit.
Definitely. And the adoption tax credit also gets an enhancement in Section 110107. It amends Section 23 and, importantly, removes the sunset date it previously had.
So making the adoption credit permanent and potentially more generous.
Seems so, yes. Making adoption maybe a bit more financially feasible.
These all sound quite helpful for working families. What about education costs? Anything there?
Yes. Section 11-10015 deals with ABLE accounts. Those are the savings accounts for individuals with disabilities. It extends the higher contribution limits and actually makes those higher limits permanent.
Okay, good for long-term planning for families with disabilities.
Right, more flexibility there. And Section 110113 makes permanent the rule that lets employees exclude student loan payments made by their employer from their taxable income.
Oh, that employer's student loan repayment assistance, making that permanent is a big deal.
It is, and it also adjusts the limit for inflation. So the value of that benefit shouldn't erode over time. Could be really significant for employees whose companies offer that.
Definitely. Now, the bill mentions something called Medicaid accounts. That's a new term. What are those?
It is new terminology in this context. Section 110115 sets up a pilot program for these Medicaid accounts, referencing a new Section 6434. From the text, they look like savings accounts.
Like a 529 plan?
Sort of, but maybe broader. The bill mentions an annual contribution limit of $5,000. And the qualified expenses seem to include K-12 education costs, not just the usual higher education or job training.
K-12 costs. That is broader. So a new type of savings vehicle.
A pilot program for one, yes, with potential penalties if you contribute too much.
Interesting. Okay, what about healthcare? Any potential benefits for the middle class there in H.R. 11?
There are a few sections. Section 110201 deals with how health reimbursement arrangements, or HRAs, work when they're linked with individual market health insurance. It amends Section 9815B.
Okay, HRAs, that's money from your employer you can use for healthcare costs.
Right. This section talks about specific types like custom health option and individual care expense arrangements, and also direct primary care service arrangements, or DPCSAs. The goal seems to be giving people more flexibility in using those employer funds alongside their own plans.
More control over healthcare dollars.
Yeah.
And what else?
Section 110208 is interesting. It says amounts paid for physical activity, fitness, and exercise can now be treated as medical care expenses.
Wait, so like gym memberships? Fitness classes?
It amends Section 223(2)(a) to include qualified sports and fitness expenses. So potentially, yes, you might be able to use your HSA or maybe an FSA for those kinds of costs.
It could be a nice little perk for people trying to stay active.
Could be. And speaking of HSAs, health savings accounts themselves see some changes. Section 110211 increases the maximum amount you can contribute each year.
Higher HSA contribution limits.
Yes, amending Section 2213B2 and G1. And those higher limits will be adjusted for inflation going forward. There is a catch, though, potential reduction in the limit based on your adjusted gross income.
So maybe phased out for higher earners within the middle class.
Potentially, yes. And one more HSA tweak. Section 110212 makes it easier for married couples. It allows contributions to an HSA even if one spouse has a health flexible spending arrangement, an FSA. That removes a barrier that existed before.
Okay, lots of potential positives there for the middle class. Tax cuts on tips, overtime, car loan interest, enhanced deductions for seniors, credits for childcare, family leave, adoption, help with student loans, new savings options like MAGI accounts, and more flexibility and maybe savings related to healthcare and HSAs.
It's quite a list of potential benefits.
It is. But now, what about the potential downsides for this group in H.R. 11? What could cause problems?
While some other parts of the bill could lead to more administrative hurdles or reduce access to certain programs. Section 44108, for example, increases the frequency of eligibility redeterminations for some people on Medicaid.
Checking Medicaid eligibility more often.
Yes, amending part of the Social Security Act. The stated goal is program integrity, but more frequent checks can mean more paperwork, more chances for administrative errors, and potentially people losing coverage temporarily or permanently, even if they're still eligible. That could hit some working families hard.
That sounds like a real risk. More red tape.
It could be. And Section 44109 revises the limit on home equity someone can have and still qualify for Medicaid long-term care services.
Changing the rules about how much your house can be worth to get help with nursing home costs, basically.
Essentially, yes. Depending on how the limit is revised, it could make it harder for some middle-class seniors who need long-term care but have built up equity in their homes over the years.
It could force some difficult choices. What else?
Section 1005 puts some potential restrictions on using SNAP benefits food stamps for internet expenses.
Limiting SNAP for internet bills.
The details aren't fully clear from just the section title, but restrictions there could impact families at the lower end of the middle income spectrum who might rely on SNAP, especially since internet is often needed to access services or find work.
True, internet access isn't really a luxury anymore.
And one more, Section 11.1105. It raises the dollar thresholds for when businesses need to issue certain information reports, like 1099s for certain payments, amending Sections 6050WE and 6050TB.
Making it so businesses report fewer payments.
Reporting payments over a higher amount, yes. It might simplify things for some businesses, maybe platform workers or gig economy participants, but it could also mean less income automatically reported to the IRS, potentially leading to confusion or issues down the line. Less transparency.
Okay, so for the middle class, potential drawbacks include more frequent Medicaid checks, possibly leading to coverage gaps, tighter home equity rules for long-term care, maybe impacts from S&A changes related to internet, and changes in financial reporting thresholds.
That sums up the main potential challenges we see in the text for that group.
All right, let's turn now to those living in poverty. What potential benefits, if any, does H.R. 11 offer this group?
Well, looking at Section 1003, there are changes to SNAP requirements. It modifies rules around waivers for able-bodied adults without dependents, ABOWDs.
The ABIWD work requirements.
Yes, amending Section 60 of the Food and Nutrition Act. Depending on the specifics, these modifications could make it harder to get waivers in certain areas, potentially meaning stricter enforcement of those work rules.
Which could be seen as a benefit by some, ensuring work, but a negative by others, losing benefits.
It's definitely a complex change with varied viewpoints.
Yeah.
The same Section 1003B also changes how certain third-party payments for energy assistance affect SNAP eligibility. Amending Section 5K, the impact here seems nuanced depending on household composition, like if there are elderly or disabled members.
So adjustments to S&P rules, but the net effect isn't immediately clear as purely positive. What about Medicaid provisions? Anything potentially helpful there?
Some provisions are framed around program integrity, which could indirectly benefit those who truly qualify by preserving resources. Section 44106 adds more screening requirements for Medicaid providers, aiming to root out fraud.
Better screening of doctors and clinics.
Right. And Section 44107 removes a good faith waiver related to states having to repay certain erroneous Medicaid payments. That starts in fiscal year 2030, aiming for more financial accountability.
Okay, strengthening oversight.
And as we discussed for the middle class, the increased frequency of eligibility checks in Section 44108, while burdensome, could theoretically streamline continued enrollment for those who navigate the process successfully. And the revised home equity limit in Section 44109, depending on how it's set, might oddly expand access for some very low-asset individuals needing long-term care.
Okay, so potential marginal benefits from process changes, maybe.
Possibly. And Section 441S, which prohibits federal Medicaid funding for individuals without verified citizenship or immigration status, while a major barrier for many, might incentivize those who can provide documentation to do so, thus securing their coverage.
A complicated way to potentially secure coverage for some while cutting it off for others.
Exactly. We also need to consider spillover effects. Could the enhanced employer child care credit in Section 110105 benefit lower-income families?
If their employers actually take the credit and offer the benefit.
That's the key question, yes. Same for the enhanced paid family leave credit in Section 110106. Could it reach lower-wage workers who often lack this? And the enhanced adoption credit in Section 10107 might make adoption feasible for some lower-income families.
And those promise grants for higher education.
Right, Sections 420S, 420U, 420V. Starting in award year 2028-2029, these grants are based on a formula involving earnings and college costs. They definitely have the potential to improve access to higher ed for students from low-income backgrounds.
So some potential indirect benefits trickling down from employer credits or specific programs like adoption aid and maybe these promise grants. But now, the really crucial part. What are the potential downsides for Americans living in poverty in H.R. 11?
Unfortunately, several provisions seem to pose significant risks for this group. We've already touched on the increased frequency of Medicaid checks in Section 44108. For people struggling with unstable housing, lack of transportation, or limited access to communication, navigating more frequent paperwork deadlines could easily lead to losing coverage, even if they're eligible.
Just the administrative burden itself becomes a barrier?
Precisely. And the revised home equity limit for Medicaid long-term care in Section 44109, while potentially helping some, could also restrict eligibility for others who might have a modest home as their only asset.
And the citizenship verification rule.
Section 44110, cutting off federal funds for Medicaid and CHIP for those without verified status. That's a huge potential loss of healthcare coverage. The bill mentions some exceptions, but they're set to sunset on October 1st, 2030. This could impact many families, including citizen children with non-citizen parents.
A major potential coverage loss. What else?
The restrictions on using SNAP for internet expenses in Section 1005 could disproportionately harm low-income individuals who rely on the internet to apply for benefits, look for jobs, or access telehealth.
Making it harder to access the very programs meant to help.
It could. And then there's Section 1902. This introduces a requirement starting October 1st, 2028, for certain Medicaid enrollees to demonstrate community engagement.
Community engagement, like work requirements.
It includes things like work, job training, education, volunteering. There are exceptions, but the verification process looks demanding, and the bill explicitly prohibits waivers for these requirements.
So essentially, work or related activity requirements for Medicaid for some groups.
That appears to be the thrust. This could be a massive barrier for people with health issues, caregiving responsibilities, or those living in areas with few job opportunities.
And one more thing.
Yes, Section 1902K. Starting October 1st, 2028, it requires states to impose cost sharing, like premiums or copays, on certain individuals covered under the Medicaid expansion population.
Making Medicaid expansion enrollees pay more out of pocket?
Yes. For people with very low incomes, even small copays or premiums can be unaffordable and lead them to forego necessary care or drop coverage altogether.
Wow. Okay, so for those in poverty, H.R. 11 looks like it offers maybe a few potential, somewhat indirect benefits related to program integrity or spillover from other credits, but it carries really significant risks. Losing Medicaid due to frequent checks, stricter verification, or new work community engagement rules, losing SNAP access related to internet costs, facing new costs for Medicaid coverage. It seems heavily weighted towards potential harm for this group.
That does seem to be where the balance falls based on these provisions, and it's crucial to remember the timelines here. Many changes don't kick in immediately, and some have those sunset dates, like the Medicaid exceptions ending in 2030 or the senior deduction ending after 2028.
Right, the timing matters. Some impacts are delayed, some might be temporary.
Exactly. And the real impact, of course, depends on implementation. How will federal agencies write the specific rules? How will states apply them? How will people and businesses actually react? It's complex.
Absolutely. A lot of moving parts, and the devil is always in the details of implementation. So to try and wrap this up, H.R. 11 is clearly a complex bill with a real mix of potential consequences. It seems likely to affect wealthy, middle-class, and lower-income Americans very differently.
That's definitely the picture that emerges. Potential tax relief and business incentives skewed towards the wealthy, but with some new limitations too. For the middle class, a broad range of potential tax cuts and family support, but shadowed by potential administrative burdens and stricter rules for benefits like Medicaid.
And for those in poverty, maybe some focus on program integrity, but facing substantial risks of losing access to critical safety nets like Medicaid and SNAP due to a combination of stricter rules, verification demands, new requirements, and potential costs.
Precisely. It's a wide-ranging bill with potentially profound effects across the economic spectrum.
And this was necessarily a high-level overview. Each of these sections we mentioned could be its own deep dive, really.
Agreed. There's a lot more nuance within each provision.
So thinking about all these potential shifts we've discussed, what do you see as the most significant long-term economic impacts this bill might have on American society? And maybe more personally for our listeners, how might individuals across these different economic situations need to prepare for these kinds of changes?
That's the big question, isn't it?
It is. We really encourage you, our listener, to perhaps look into the full text of H.R. 11 yourself, consider these different perspectives, and think about what it might mean. Thanks for joining us for this deep dive.